All right, good evening, guys. Ken at Tortoise Capital. This is a small group check-in for February 19th, 2024. I want to welcome everybody on board. I need to pass on some bad news. Chi Wing Chong is he's got to defer for a while. He had a medical emergency in his family that's going to demand his attention, for the next while. So I would ask you to keep he and his family in your thoughts and prayers. He sends his regards, sends his regrets. That's kind of typical of him to worry about other people, but he would really benefit from all of your good intentions and prayers. So I want to pass that on. Okay, so yeah, we had no trading today because the market was closed for President's Day. So we will not have a follow-on session after this. So we're not pressed for time at all today. And so let me just open it up to you guys real quick for about a 10-second check-in, just see how we're doing. Jeff, how are things going with you?
Going very good. Good week. Excited.
Yeah. Jonathan, how are you?
I'm doing okay. Just rolling along, trying to make a little make some progress. But okay,
Happy to be here.
happy to be here. Better something.
Nice. And Juan Carlos, how are you, sir? Doing all right?
I'm doing really good. Very optimistic and hopeful of seeing all this being put together.
Yeah, it feels like it. I just saw your notes. It looks like some interesting things to talk about tonight. Moving right along. I had a pretty good week this week. Let's see. Had dinner with my best man from my old Ranger Battalion days. So he's known me for 40 years, and he's still working in Department of Defense as a senior war planner over in the Central Asia area, working at the very strategic national level. We had a nice chance to catch up. He finds himself in the unusual position of being, as he likes to call it, just a dumb infantryman, but he's in support of Air Force war planning at the highest level, which is kind of refreshing because you have a guy that really understands the requirements on the ground, working on our strategic level planning. And so it's always a great time to see him and to get connected. In the area of creativity, things are moving along pretty nicely. I had a good conversation this weekend with Angus Fletcher. He has done a nice presentation as a TED Talk at Oxford University that was talking about his experience with creativity and storytelling and story thinking as a way to overcome anxiety and stress and to tap into the natural power of our brain to create solutions where there only seems like darkness the first time you look at it. He calls his technique one door two. And it starts with the idea that when you first get surprised with a disaster or chaos, whatever, it doesn't seem like there's any way out. And that generates anxiety. And it's like being in a dark room with no doors. And then you can imagine one way out. There's only one way out of this thing. And then that makes you angry. The anxiety converts to focused anger that there's only one exit, and that thing may not be beneficial. It's better than nothing, but it's only one way out. And so he teaches a technique with story thinking to use that anger to provide the energy to think of just one more possibility. What's one more thing that we might do? Take one more step, and using the anger energy to do something positive, like create an alternative, no matter how silly or crazy. Because once you get into that mindset of looking for just one more thing, one more way, it can often be the breakthrough that leads to loosening up the trick that you find yourself in. So it was a nice presentation at Oxford Club, and I had a lot of fun talking with him about that and the idea of story thinking that we've been developing as a way to affirm that what he's talking about on a theoretical basis and on a practical basis with his clients is that we're seeing the same things in our work with soccer players, with kids, military officers and traders and doctoral students, that story thinking and creativity is looking to be very, very robust and getting a wider and wider acceptance with every passing day. So it was a pretty good weekend for me, reconnecting with buddies like that. And I'm excited about our week ahead and excited to listen to what you guys have going on here. So let's have the first man up. Somebody step up here and let's get us started. Who's ready?
I can go ahead.
All right, Jonathan, go ahead.
Still continuing my work on my processes, my stalking process, and then my execution during trading. And I didn't get to trade as many days as I wanted to last week, but feel like I did make progress in all of that. I feel like as far as my technique with actual trading and execution, I feel like that's getting better. I'm picking up little tips every day. So I feel like that's improving. I think still the biggest thing for me to work on is how I'm sorting through names and picking out what it is I'm going to focus on, and then how I focus on that during trading. So, if I generate a lot of names to look at on a watch list, then once the market starts moving and I'm on 3-minute time frames, then it can be a whole lot to look at. On the other hand, my span of control is not super wide right now with all the new things that I'm learning. So if I get into a couple of names and I'm trading, and maybe I get a trade or two, and it's kind of a natural endpoint, then I've got a choice of continuing to watch those throughout the day as more trades generate, or try and look for something that I think might be better or have new setups. And it can kind of go either way. That could work out, but often the names that I was looking at, if I'd continued to follow them, trading those names would have just been fine. So it's still trying to get how many things I need to be looking at, how many things I need to be on my list, how many things on my plate, and then how I sort those before the market. And just looking at what you're doing on the daily report with the 30-minute charts, I mean, it really looks like you've got your list of 30 names that you go through from the kind of the sniper list that you have, and you've got your support and resistance from higher time frames marked off. But it seems like you really are just trading whatever you see. You're not necessarily looking at what's happening on any of the time frames, what the trends are, where they are. You're just looking at all 30 of those names, and if you see a setup, you're just taking them. And so for 3-minute bars, how many? I've got to figure out how many things I really need to be. I hope that makes sense. How many things I need to be looking at in that regard? That just seems to be kind of my kryptonite right now that I need to work through.
Okay.
I hope all that made sense.
Yeah, it sure does.
Okay.
I think the one of the really helpful natural models for trading that I find really useful was watching the way lions hunt, or even wolves. The pack animal.
Yeah.
The lions are taking a look at the herd is moving towards the watering hole, you know? And they know the herd has to go there. And maybe there's some bushes, support and resistance lines over in here. And those damn lions have got it figured out. You know, they're going to park some critters inside here and have, you know, the designated attacker. And what they're doing is they're picking out from the herd the oldest, the weakest, the sickest, the tiredest, you know, the low hanging fruit. And they know that when they let the herd get over up in here, if this one charges, it can only either go this way or that way. And either way, the herd breaks. And some of them will break in both directions. Either way, the herd breaks. They're going to run right into a lion who's going to jump out and ambush them and startle them with that yell. And they overwhelm them with the sound. But even when you have a whole herd of lions attacking one little animal or whatever, they're successful, maybe 1 out of 5 times. They're not really all that efficient, even when going after, you know, the oldest or the youngest or the weakest or the sick. But there is they are as efficient as they need to be. You know, it helps that they're going for a zebra or a wildebeest, which is large enough to feed multiple lions when they make the kill, as opposed to chasing rabbits. You know, the cost benefit analysis of a rabbit doesn't make any sense for a lion. But I guess the point that I would make there is that, you know, them understanding where the natural support and resistance for the channel is and the no-go terrain, which means the price can only go that way or that way, really has narrowed it down. And if you watch them, like, wolves will do the same thing. Like if we're looking at a top level of a cliff and here's the river way down there, and so there's the cliff that leads to disaster, and that thing that wolf sees the animal running this way, and all he's doing is just kind of guiding him into, hey, if I go too far this way, I fall off the cliff. So he's just easing in, so it just takes away all his choices, and then he makes the strike when the run is done. You know, he's relaxed, and he's just trying to contain it, and he's trying not to fall off the cliff himself, and he's just going to use his superior body weight and he's either going to make the kill right here, or the thing's going to fall off the cliff and get killed in the fall, and then he's just going to climb down and go get him. You know, so in both of those cases, it's part of that knowing the territory and knowing your setup and really understanding what your win rate only needs to be, you know, without trying to be perfect, and how to be relaxed on it. Say even if I miss them this time, they got to come back to the watering hole. They have to, you know, and so part of this is target selection. But one of the things that you'll also see is once they lock on that target, they will run right past other animals that are closer to them because they can't even see the other animal. They're so locked in on the thing that they're concentrating on. So that gets into this notion here about the time of day and scanning. And the best way I can describe that is you've got 2 different scanning processes. One of them is really unfocused. Wide angle peripheral vision, where you're not looking at any one thing. You're just looking at the left and right limits, the north and south limits. And what you get what you get attracted to in that kind of visual field is contrast, or something's moving when nothing else is moving. So when it comes to like time of day, if I were to map the volatility, in the opening, 2.5 or 3 hours, you get a lot of volatility as some things are going up and some things are going down, and some go up and then down, and then some go down and then go up. There are a few things that will just open and then kind of stay in the middle all the time. But then there comes a time, when the Z3 lines are contracting and all of these other things. Now, maybe it's the thing that just keeps going forever and ever. That should stand out immediately. If you've got a stack of the elements in your herd and you're sorting it by percent, if something is like this, that's going to be good and just going to keep going. Now, my platform, my brokerage platform, it flashes a light every time there's a trade made. And if they hit the bid, or if they hit the ask, excuse me, then it flashes green. So if I see a bunch of green lights flashing up here, I know that they're buying at whatever price the seller wants to sell. So it's all green lights. And it flashes red if they're hitting the bid. In other words, the seller is selling it to you at the price that you want. That's actually negative for price behavior, because they're coming down to your price and selling it to you at what you're willing to pay for it. So what I notice is that when I sort by that percentage, and maybe these are the ones these are positive for the day and those ones are negative for the day, and then these in the middle are maybe just hovering around zero or something like that, or just stuck in the middle. I'll notice that when the market is going up, that all these ones that are at the top are all flashing green. I mean, they're buying them at any price. Well, that's good. That's good to know. And when you see that in conjunction with expanding volatility, you just sort of get the feeling that, hey, those are the things that are working. So stay focused on them. When it gets kind of into the lunch period, the maybe trading frequency slows down. You don't see as many green light. You start seeing, even in the ones that are green for the day, you might see some red lights flashing. And that's indicating that maybe that move is starting to reverse, because now it's getting, they're having a harder time finding buyers to entice them north. So the bid's coming down. Around the lunchtime, everything is just kind of motoring along in this little thing. And then if I'm using that wide angle, unfocused peripheral vision where I'm scanning that whole sector, one thing I can do is I can be watching that on one part of my screen. And then I might have 8 thumbnails where all I can see is the shape of the dragon sticks out, because that's a thick orange line. And so depending on if it's an up day, well, I'm always going to be interested in this. I'm going to see this one and realize, hey, if I'm in that trade, I better be thinking about a stop. This one, I hope I'm short. Why am I not short yet? And then I can double click on that, and I might have 4 larger charts over here where I can, click that one and put it in here and say, here's what that's actually doing, is that the that price is looking like this. And price has been large, and then it's slowing down. And that feels like maybe this is a thing that could go this way. So maybe that gives me an opportunity to say, hey, I really like that pattern. So if that holds, then maybe I'm going to see an SSC in here somewhere. Or maybe it's going to fail into a collapsing dragon. So I pick these 8. Like I always am going to have SPY on here. And I'm always going to have VXX in here. Because I want to see volatility and the market in there. And I'm always going to have DIA and the Russell and Brazil and Mexico. Because those 2 are frog champions, and I can trade them even if the market and the volatility in the US are not doing anything. I know that I can always find a trade in those 2 because they're very liquid. They're large markets. They have their own currency. They are independently correlated, or they are less correlated to Europe and the US and Japan and Asia. They're their own thing, but they're very large. Mexico is the largest emerging market in the world. So I always have those 2, and then I might have 2 specials in here based off of something that's happening from this deck. Hey, that thing's really starting to flash green and it's going up. Okay, maybe that's Alcoa. So maybe make this Alcoa for a while and I'm stalking that. So I can watch those 8 pretty easily. So if I have a couple that I'm stalking now for special reasons, and I have 6 that I'm always stalking anyway, that gives me a very comfortable feeling that I can watch all 8 of those at the same time and see which one is interesting. And then I can, yeah, go ahead.
So I've done a version of that. I've got the list, and I'm using the sniper list of 30,
Yeah.
30 names, and looking at what are the biggest gappers, biggest movers on open, both long and short. The list that you've got there, I mean, you've got 6 names that are constant and 2 that are you're adding in maybe from the biggest movers. And one thing I've done is I've like tried to go through the night before and come up with names, and sometimes it's a lot, and I've got to sort through those and put those up on my thumbnails. But that means that I'm going to be looking at different things every day. I mean, would I be better off to have just a constant list of? I mean, though I could do those 6 and then just pull the biggest. I mean, that if I do
if
it
you
that
think
way,
about
there's no.
if you think about it, we had a conversation about narrowing that list, and I suggested maybe that what you have is the old reliables, picking 2 of those, maybe continuation patterns from yesterday. Yesterday it was a live trader. It was in play, had a larger than normal range, so and that trade's not over yet. Like like maybe a continuation trade is something that looks like, hey, it opened here, it sold off, and that thing had a large range day and it closed up here, and the VWAP was like maybe the VWAP was something like this. What a perfect day. That's a large range day. It was very directional. The VWAP showed continuous buying all day. And all other things being equal, I know that if tomorrow it gets north of that thing is a raging buy. So that ain't over yet. If I had a 5-day down and then the next day it did this, it gapped down, had a morning hook, that could be day 1 of a 3 to 5 day swing trade. And if it gave me this kind of a pattern, then it's going to be in play tomorrow. So that might be one of those 2 slots. And then if there was new signals, like a new 5DD, I might pick a couple of those. And then what I think of as the old reliables are, for me, it's like these six. Uh, Now I don't always trade SPY. I mean, I actually rarely trade it, but I always watch it because it's the market. And I want to feel what the market is doing because the market is worth about 50% of all the things that I trade. So if I understand the market, SPY, it's going to influence everything on my list. What kind of day is it in the market day? Oh, it's a quiet day with no direction. Oh, okay. Well, don't try so hard. Oh no, it's a big directional day. Here we go. So and then I have VXX on there because I'm interested in those two because I talked about this Sunday morning that if you take a look at the time series of how volatility works, the first thing that changes are the things that have the most fear in them all the time. And the thing that is most afraid is a leveraged intraday trader who's trading index futures with a lot of leverage. Okay. So what do those guys pay attention to? They pay attention to the VIX because that is the fear gauge. That is the implied volatility of futures contracts in the S&P, and that tracks how much they're paying for that insurance. If they suddenly feel nervous about protecting their leveraged long positions, then they're willing to pay a greater price to buy the VIX insurance. So anytime those shortest term leveraged professional traders start feeling fear, the VIX starts moving first. And then the next thing that starts moving is the Russell 2000, because that is a favored trading instrument for professional traders. And the reason for that is it's not the Dow. Okay. And I'm going to jump to the end of this discussion by saying the thing that is the slowest to react to fear is the Dow 30 Industrials. Why? Because that has 30 of the largest companies in the world that are bigger than most countries. It takes a lot of money to make those things move. Like there's not just jumping at shadows. There has to have been considerable volume being traded to make DIA budge. Like if it's going up, it takes a lot of money to make that thing go up. And then all of that buying has to disappear and be replaced with selling. It takes a lot of money to make DIA move at all. So it is the slowest thing to react to changes in market psychology. The Russell 2000 is the first one that is connected to anything real. VIX is the only thing that it is connected to is the emotional state of professional leveraged young gunslinger traders that are existing on caffeine and cocaine. I mean, that's how substantive the underlying instrument is. It's their feelings and their biochemistry. So there's nothing tangible in that at all. It's their own feelings and then what they feel about other people's feelings. So they're jumping at shadows made by shadows in a dark room.
Well, it
Their
sounds
sense of-
like if you do it this way, I mean, there really is very little prep. You're basically you've got your regulars, and then maybe the night before you run through the 30 names and see if there's a few that look like maybe they're going to set up an SSC tomorrow if they continue, or
Yeah.
Things that you like about them, and just pick out a couple of the best ones of those. And then you're basically just walking up to the market, looking at that percent move when it opens and just saying, okay, well, what's moving right now?
Exactly.
Pick a couple of those to walk around, or
Exactly.
to watch. And it's as simple as that.
And then I might have a couple of hey, if I didn't have any continuation trades from yesterday and there were no new signals that were any damn good, and the market didn't gap, I'm trading my old reliables because they could just start moving just because on a relative basis, they have a larger signal to noise ratio than other symbols, and they have large ranges as a percentage. They have large percent ranges compared to other things. Like XLU is never going to be on that list. That thing barely moves intraday. It has a frog box of about 3 pennies. It just doesn't move. And so if you're going to try to make money in utilities, the size of the position that you have to put on is so huge that all it would take is one guy burping to make it move 5 cents. And now suddenly it's brutal, where it could have been just a nothing. Well, on this little volatility curve, the reason that I put SPY and VXX in here is, number one, they are both tradable. I mean, they can be traded. There's a lot of volume, and VXX especially moves a lot intraday. It's like 5 times the volatility of SPY, and it's fairly directly inversely correlated. SPY goes down, VXX goes up, because volatility is the enemy of gains in the equities. But what I'm looking at that for is sort of this volatility condition. So the VIX has nothing substantive that it's anchored to. It's just feelings about feelings of fear by the cokeheads. The Russell 2000 is connected to 2,000 small caps, but each one of them is so small. There's not a single company in the Russell 2000 that had a news alert today that made traders who specialize in it suddenly buy or sell a whole bunch more, that's having any measurable effect on an index that is composed of 2,000 small caps. All right. There's not a single company in there that can move that index in a measurable way. So what it really is it's a way to get exposed to a broad asset class that is got the attention of traders intraday. Traders intraday like the fact that there's a lot of money in the underlying elements because there's 2,000 companies. So there's actual substance, but they don't have to pay attention to any of the research about any of those. They have to do any fundamental analysis. All they have to do is watch the other traders trade, and then they can trade against the psychology of their traders. So that's actually one of the reasons that it's a great index to trade, is that if you're trading it actively, quickly, it's not going to be influenced by the noise of news. Hey, the Russell 2000 just made a 1% move. I guarantee you it's because traders came in with leveraged and were buying it hard or selling it hard. That's the only reason it even moved. So you actually see it has a relatively low signal to noise ratio because the Russell 2000 trades like this intraday. In the R10 or the RL10 might look like this, but the outer limits of that thing, if you took a look at how wide the normal channel was, it's going to be very wide. Because there's so much buying and selling on the beat in the short term. So that's one of the reasons you like trading with the RL10 is it smooths all that out, and you can see what price is actually doing without getting distracted by the size of the bars. It takes a really big move to break out of that channel. Whereas when you get all the way down, now we're going to keep going to the east here. Now the NASDAQ 100 instead of being anchored to 2,000 individual small caps, the NASDAQ is anchored to 100 technology companies. Oh, but it's market cap weighted. So what it really means is that about the top 10 or 5, can't remember which one, it's like the top 5 or 10 of those is accounting for about 70% of the index. So these are the mega caps, guys like Facebook and Microsoft and Apple and Facebook and the Google. How those things are moving is pushing that index around. Now, it takes a lot of money to make companies of that size that are worth $1 trillion or more to make a significant move in their price. But because there's fewer of those companies that are moving the index, you could have individual company buying and selling splurges that could actually contribute to the index moving. But then you also have index buying that is being attributed back to those large cap companies and making them move. So when you look at the NASDAQ and those companies, sometimes the NASDAQ moves them and sometimes they move the NASDAQ. Now, they are narrowly focused because that's all technology. So if I was looking at the S&P 500, the technology sector is about, by count, there's about 80 technology companies in XLK, which is the equivalent of the Qs, inside the 500 companies in the S&P, but it has considerable components that are not related to technology at all. So what you get with the NASDAQ is a really tightly focused index on one particular sector, and you can trade it with leverage with incredible volume. And most of the movement in tech is driven by a news event in one or two of those companies, but because it is also the engine of change, it also has some momentum. So that makes the NASDAQ and the futures contract in the NASDAQ a really valuable target for traders. So one news event in Apple could suddenly have a carryover into Intel. Oh, Apple's they're having trouble selling inventory, so they're not going to buy as many chips, so Intel's going to go down or something, or some of that kind of crap. The S&P is larger than the NASDAQ, but it's got 500 companies, but the top 100, which constitute the OEX, are responsible for most of the movement of those 500. But those are all, that's 100 big companies that are moving the S&P, and they're in the 9 different sectors. So it moves slower as an index than the NASDAQ does, which moves slower than the Russell does, which is not affected by any single underlying instrument, which moves not as fast as the VIX, which is smoke and mirrors. When you go all the way to DIA, you're talking about the 30 biggest companies in the world pretty much in a wide variety of sectors, because you got General Electric, which is a finance company. You have General Motors, you got, Microsoft, but you got banks and industrials and all that stuff. So one of the things that'll happen is you'll notice, intraday, you'll get the, selling will calm down and then everything will get really quiet. The first thing that breaks out of this is going to be what? It's going to be VXX. That's going to be the first thing that pops. And then there might be enough to that triggers the Russell 2000 traders who are also aware of what's happening with volatility. They might then, a few seconds later, 10, 20 seconds, they might start trading because they notice the fear gauge just got triggered. And that might cause some NASDAQ traders to trade. Maybe there's a guy that's trading all three of those because those are his three instruments, and he starts trading the one that moves first. The thing that I like to look for when it comes around to, during the day and when to shift focus and all that is when everything is really quiet, I start watching the VXX and the VIX to see what's the first thing that starts popping in which direction? And is there some momentum? And does that momentum spill over into other instruments? Like it starts with the VIX, quickly goes to IWM and EWZ or the Qs or whatever it might be. But the thing that I actually like to execute on is DIA. Because 1 penny in DIA controls $5, or I'm sorry, 1 penny in the YM contract represents a movement of $5 of value in the contract. So if DIA moves 10 cents, you're talking about a $50 move. And if I notice everything was really quiet, let's say the Dow moved up hard and then got very quiet, and the whole market is quiet because the whole market looks like this now. And now suddenly SPY starts dropping and VXX is going up. I said, oh, it could be that the first surge of new trading interest is going to be to the downside. And that volatility has not moved far enough over here to the right to affect DIA. But now what I can do is I could even think about getting short right now with a really tight stop so that if this stuff all starts failing, then out of sympathy, maybe the Dow starts to move. Well, I can put a 2-cent risk box around that before it starts moving because it is so hard to make that thing move in large chunks.
So that's something you might do coming out of lunch when it gets everything gets compressed.
Yeah. So I actually start when there's absolutely no movement. That's when I'm using the widest lens possible, looking at width and depth just to see where's the movement? Where are the rabbits running? You can't steer at a bush. Is there a rabbit in that bush? And if there is, I'm going to see him when he moves. No, you got to learn to unfocus and look like an eagle, wide angle, and then your peripheral vision will pick up the motion. And then that's when you quickly shift into focus mode and bring the binoculars in and then lock in on the target to the exclusion of all else. And that's why those predators that are only successful 1 out of 5 times ain't no rabbits killing no eagles. The 4 times out of 5 that he misses, he's going to be okay. I guess an antelope now and then might kill a lion if he gets lucky or he chokes on a horn or something, or it's unlucky, sprains his ankle and the hyenas eat him or some shit. But the cost of failure to them is trivial because they got 20 or 30 attacks inside them before they start getting desperate. Maybe they got 100 attacks before they're too weak to hunt over the next 4 or 5 days, and they only got to be successful on 1 out of 5. I like my odds as a lion, it's good to be king. Lets the female lions do the hunting, and the male lion defeats other male lions and kills the occasional hyenas just to prove a point, so this array of widest angle stalking trading, those 3 sections on my screen allow me to use the kind of vision that I really need. I'm just feeling my way through the choices, and just see where what's starting to move. Well, it's always the things at the bottom or the top are the biggest movers, But if all of a sudden they start flashing lights and there's a lot of trading activity, I'm a mammal. It gets my attention. And then I can drop that into my stalking as I start approaching the herd as it approaches the watering hole. And then when I pick my targets, I can put those on and then just kind of fine tune the entry. So I can take a look at each one of those little tasks of examining the chart while it's moving on 3-minute charts. On a 3-minute chart, literally 5 seconds to know if I have a decision to make. And I can see that decision coming from minutes and minutes away. You know what I mean? It's like if it's in the harsh winter and it gets a doji and then it gives me a 1-2, I know that the soonest I could get into that could be 3 minutes from now. If that thing breaks out,
Yeah.
if it doesn't make a new low, compared to here, if it doesn't make a new low right here, then I can actually get in if it breaks out from here. And then my stop is going to be down here somewhere, whatever some brute force R10 or R5 is going to be, or the, below the swing low. What if I know how big that box is? Now I can see that developing 5 or 8 minutes away. And I'm just waiting. It takes forever for those. I got to make a decision in 8 minutes. So I can make that one of these over here. And then maybe these two, maybe I already got the entry and I got to no lose plus dinner for 2. And now I'm using a trailing stop of the PSAR. I'm just watching that thing. The thing is still in that bar. It hasn't hit the PSAR. Nothing to do. You just watch it. And then when the 3-minute bar is over, I can,
Okay.
am I getting closer to a decision or farther away? Oh, I'm getting close to 1 full R in hand. Oh, maybe what I want to do is accelerate my stop and just notch it up a little bit until the PSAR catches back up. Okay, make a decision, move it 2 seconds.
Yeah.
If I'm
Okay.
thinking about it, just move the stop. Move the stop, done.
Okay.
So I can be trading those 4 things on half my screen. So you got 40-inch monitor, so the thing is 20 inches wide and 20 inches tall. That means I got a 10-inch by 10-inch chart. How big does that need to be? I can see that. And then these can be 2 inches by 2 inches or 3 inches by 3 inches. And then this one that has 30, that's like, half an inch, tall, each little line item. So in terms of screen real estate, that's all manageable on one screen, and I can just, I can just watch that. Now, that comes from 45 years of combat operations too, where I'm watching units moving on screens and maps and map boards and visualizing and listening to radio chatter and watching units move and reading a table and then trading for 35 years. So but that's why instead of just 2 old reliables, I probably have 10, and all of them are on that list of 30. And 6 of them I already listed: DIA, Brazil, Mexico, Devon Energy, Alcoa, IP.
Okay. I guess some of it's getting more experience so that I can process more.
Yeah. So as long as you have those 4 categories of symbols, like these were the gappers and movers intraday, and the old reliables, and then any new signals from last night's report, and then any continuations from yesterday's report, that gives you the 4 different categories of things. Now, it may be, as you're going through your expertise and practicing, it may be that what you really like, hey, you really like the gappers, because look at how much work I don't have to do.
Right.
Or
Right.
conversely, you know what? I really like specializing in 5 or 6 symbols that are coming from different sectors. I like Alcoa and Cliff because it's metals and steel and aluminum. And I like, fuck, I don't know, Devon Energy because it's energy. And I like um, uh, trying to think, maybe let's see, TFA or F. It's the thinking of the triple leverage finance ETF. So maybe I got a bank in there, and I got a energy, and I got metals, and I have tech. So if I just had 8 companies and just said, I'm going to trade those. So you might be just concentrating on the old reliables and not even spend the effort getting things framed out based on swing trades. Or maybe you like those, maybe you like the sniper one day at a time. Maybe it's just the auto framers as a simple signal generator for something that is primed to move. So my advice about using those 4 categories was so that you get a little bit of diversification in target selection to see what resonates with you.
So what you mean by the continuation, you're talking about the auto framers, you're talking about looking at this, what I, as part of what I'm doing, looking at the setups the night before and seeing, and I'm looking at them, I'm looking at the daily and seeing what that looks like.
Kind of yes, kind of yes. But what I'm really thinking about on the continuation pattern is this was something that moved today. Now, maybe it didn't even have a swing setup. Maybe just for no reason that we could detect at all, it caught us completely by surprise. It didn't hit any of our screens, but the damn thing had an 8% move because of some news event out of the blue. And we weren't prepared to trade it, so we didn't trade it. But the damn thing moved 8%. Do you think that it's done? No, it's not done. Because everybody that didn't trade it, that now regrets not being ready to trade it, is now going to be ready to trade it. They want to get the second day momentum, especially when you think about that's one of the beauties of the sniper and the 5-day volatility statistic, right? One of the things I love about the sniper is when those 5 days are really small volatility and it's sideways movement. That means that for 5 days, it hardly gained or lost anything, and the daily moves were all small. That thing is just poised to break out. And then today, maybe it does a big sell-off and does this. And now I've got 4 days here of nothing, and then one huge day with an enormous breakout. You know what will signal? That'll be like minus 300 on the NDX 10, right? Because the previous 10-day range was probably like this. And then this thing closed way down here. And it's so far away from the previous 10-day range, you get an enormous reading on the NDX. Well, everybody that looks at that says, is that done? It's either going to be a really good reason that thing is going to keep going down, whatever the news event was that triggered such a horrible sell-off. So there's going to be a continuation to the downside. Or they're going to say, oh, there's nothing to see here. That was an error, or that should never have sold off that much. Now suddenly I got a great company that I can buy on sale, and then you'll see it immediately recover half or more of the sell-off. Well, if I see that one big move down, that's going to be a continuation pattern for tomorrow, because something about today's price action was huge that told me this thing could be a great move tomorrow. Hey, what if that thing broke out of the 10-day range and now is sitting right at the bottom and made a new 30-day low? We're sitting right at the last 30-day low. And the last 30-day low, it recovered and came all the way up into here. And now this thing had a 1-day sell-off, and it's down here once again at the 30-day low. The last time that thing went screaming north. So this thing is either going to scream south because there's a real reason it's sold off, or it's going to be a raging buy because it's a great company on sale. The least likely probability is if it just goes sideways at the new suddenly correct price that they discovered in one day. That's the least likely result. So when I say continuation, all I mean is, how do I scan for that? On my stack of 30 or 60, what were the biggest percent movers in either direction? Who were the biggest winners and losers? Let me go look at their chart real quick and see if there's some rapid frame that I could put on. But they're probably going to continue to go tomorrow. It's like the a golf ball bouncing. You know, you drop it from a great height, it bounces halfway, and then halfway, and then halfway, and then halfway until it finds its new proper level. So maybe I don't get the first one, but these next 2 or 3 days could be very, very interesting. They may be so interesting that it generates even more momentum just because of momentum. So there could have been, I think there's a lot of swing trades that happen that there was panic selling for no apparent reason, and then momentum selling triggers more momentum selling, and everybody says, well, Christ, I'm not going to be the last guy trying to own this. Let me get on board the panic train. And that's why you get the phenomenon that when you look at the great sell-offs in the market, the worst 3-month sell-off, most of that occurred in the worst month of that 3 months. Like, it's hard to sustain brutal, fearful selling more than a month, because it's like, who else hasn't heard that this thing is, you know? And so you get more than half of the worst 3-month period in that 1-month period. And then if you study the 1-month period, you get more than half of that selling in 10 days. And then if you look at the worst 10-day period, you get more than half of it in the worst 5-day period. 5 days seems to be how long it takes for everybody that is driven by fear, greed, emotion, lack of confidence. It takes about 5 days for a full-blown bear reaction to just assassinate everybody with the worst possible things, right? So if I had this little bit of quietude up in here for 5 days in a row in a tiny little range, and then suddenly I get 1 day of bad selling, you bet your ass that I'm going to go watch that. Because maybe that was the first day of what's going to be a horrible 5-day sell-off. I'll be on that one like white on rice. That's why the collapsing dragon, on every time frame, on any time frame, that's why I love that. Do you think that those professional intraday traders draw a distinction between day trading and swing trading? No. They're looking to pile on and pile on. They know that there could be up as many as 5 days of rapid expansion, and they're going to keep hitting it intraday hard with leverage, and then taking the leverage off near the end of the day because it costs so much, and then putting the leverage back on in that direction the next day. And then if there was a horrible 5-day sell-off, and then it ends in a doji, and then starts going back up, how fast are they going to shift their belief to the other side of the trade? Instantly. Because they're going to bracket the doji like we do. All we're doing is what they're doing. But we are understanding the statistics of 1-day moves, 5-day moves, and all that stuff. And what we're doing with these different patterns is finding things that are more prone to those kinds of explosive surprise moves for our short-term trading opportunities. That's why, to me, the 30-day or the 30-minute chart is ideal for this intermediate time frame in here, because I can see the turning points where it made a turn on 30-minute bars. Easy. And then as it gets close to one of those turning points, I might even dial down to the 3-minute and fine tune that turning point and try to just get my risk out, get a little position on, get my risk out, kind of build it up, and then give it back to the 30-minute chart to watch as it just continues to grow.
But if I'm trying to focus on the 3-minute, if I have those on 30 minutes.
Yeah.
I'm concerned that, the move will already be, gone on
Yeah.
the 3 minutes. So I've been keeping those charts on 3 minutes too.
Yeah.
And
So
take that.
yeah, I think that happens too fast. There's too many things moving on. I would
Okay.
say if on these intermediate ones, like if I had, this was one of my 8, and I have that on a 30-minute bar.
Okay.
And I watch the dragon do this and then do this and then just start to hook up. I can now say, aha, there it is. And now I can bring that over into this and then fine tune that and then on this little part of my chart, I can put that on a 3-minute. And I might have seen that thing. This was the price action that caused the dragon to hook up. And maybe I got, hey, maybe that is on the 3-minute. I might see that just as that price is crossing the dragon. And I might be getting a 3-minute RLXD entry where after it just did the hook and crossed the dragon, maybe that's what that chart looks like on a 30-minute. It was just the bottom of the dragon was just starting to hook. And that alerted me to, and if I can get this entry here, if it's going to work, the next 3 to 5 bars, that's 9 to 20 minutes of movement. That's going to be 1 bar. It's going to be 1 bar on this chart. I have 5 or 10 bars on this to watch that thing unfold. And if you can see 3 or 4 bars going up, you're already at no lose plus dinner for 2. Easy. And now you could just let that be what it's going to be.
Hey, Ken, are
Yes,
you,
sir.
in that situation, you have a long bias, or would you take a collapsing dragon if it started to roll on the 3?
If it does this little hook and it's the SSC,
Yes.
I'm trading it long, but I also instantly know where this collapsing dragon is, and I know where the collapsing dragon is over here. And it'll hit this one first
Sure.
before it hits that one, just because the way the math runs. Because the bottom of the dragon over on here may be pretty close to the swing low over here. It depends, but you'll either one of those is a reason to get out. It may be a reason to get short. If it was a true collapsing dragon, then it's a reason to get short on either one of those time frames.
Okay, thanks.
So I wanted the point in quick summary, I wanted to reinforce the idea of the times of day and how to scan. I have to have both of these qualities. I have to have a unfocused wide angle lens so I can simply detect a change in movement behavior. It's starting to move where it didn't move before. It's popping out of a sideways quiet channel, or it just completed a big run up and now is starting to not move. It's getting into doji action. The absence of movement where this thing was starting to move and now it just stopped. That gets my attention. So this wide angle peripheral vision allows you to watch the members of your herd. If everything in the herd is going up, it's that kind of day. It's easy. You're watching for the first thing to stall and fail. That's the weakness. That might be triggered by a sudden rising in the VIX, and then the Russell starting to stall and fail, and then the tech beginning to lose I'm going to get ready to trade DIA, or I may be long DIA. I want to make sure, and I'm using that as a logical tightening of my stop to maximize my capital gain on that move. So I'm not giving back a lot because it may not fall yet, but it just stalls and everything else is failing. That's a reasonable time to just cash it and get ready for the next round. So I really, I'm looking at the time of day. I'm looking at, I'm stalking in a certain way. I'm considering what is on my short list and how I move from the list to the stalking to the tactical display. And right now you should just kind of be looking to see what is the process that allows you to go from plan to prepare to execute. What feels the most natural, the least controversial to you. And that gives you 4 different ways to think about how to generate your watch list and your prep list.
Okay, okay, that gives me
And
a
then
lot.
just remember lions and wolves.
Yeah, that's a great metaphor. I like that.
I mean, 1 out of 5. And they are concentrating on that little one right here. And they will run across the herd. Like they won't even see these things that are, he could just reach out and swipe and knock them down and kill it. He doesn't. He runs right past it. He can't even see it because he is so locked in on that little thing right there. That is what he's going to concentrate on because that's going to feed the tribe or the whole pride or whatever it is. And we got to, there's an abundance. The main point is that there is an abundance of symbols, an abundance of opportunities. And how many do you actually have to get to feed the bulldog, to feed the tribe?
Right, that's one of the big questions I'm trying to answer is, how many.
Yeah. So don't even worry about that yet. Let's just get 1 shot, 1 kill.
Okay.
And with skin in the game until we groove our swing.
Okay.
And then, once you can groove your swing at that position size, then you can start doing that because at this point you're piloting and out here you're in production. And you want this to be refined.
Right.
All right.
Okay.
Juan Carlos, you ready?
Yes, ready.
Fire
So,
away.
all right, hello. So this previous week, I really concentrate on risk, looking at different aspects of risk.
Yep.
And at the end of the conclusion is standard deviation of the 30-day range, as explained. It's a generic way of being able to find the risk in the, or to find reward, a way to generically find reward in different symbols. And then tactical, it's always depending the pattern. If it's a channel, then it's support and resistance. If it's SSC, then it's the RL10 and so and so. So I decided to stick to those because it's what we've studied and what we looked at, and seems to work fine. I continue looking into the 10-day high and low. Oh yeah, right. The frog, the FQM to find intraday and big moves or big movers.
Yep.
Yes, I have a filter for that. And what else? Yeah, on the 10-day highs and 10-day lows, I continue looking into that to find where money can be made. Although I stumbled into something you just touched, which is continuation patterns. So I have a good move, let's say 2-day move that went from the low of the 10-day to the high of the 10-day. And then my continuation pattern doesn't fit the filter of two rewards to one risk within the 10-day high and low. But it's a continuation pattern. And how would I be able to identify that?
Yeah, let's talk about this little series right here.
Mhm.
So this was yesterday's that was yesterday's trade. It just closed. Or let's say it just closed today. It just closed right here. And let's say that it gave me the usual 5-day down.
Mhm.
So 1, 2, 3, 4, 5. Aha. 5-day down. And it made a new 10-day low. The previous low was probably here. So this thing had so if the previous 10-day low was here, and then it closed down here, it has like a reading of about 0 or -5 on the NDX. So it's horribly oversold. And it's a 5-day down, so we know it's a swing. Well, that means that when I set this up, the 10-day high is going to be my mechanical risk, or my mechanical reward. So in the auto framer, I am simply taking the daily risk, which is the daily range plus or minus 5 cents on each end, right? And I can say 1, 2, 3. Hey, great. It's a 3-to-1 swing trade just back to the 10-day high, which was maybe this, and then it was up and then it was down. So this little bar right here gives me a mechanical entry north and a mechanical entry south. And then I have a yellow zone, which is yesterday's range. Inside of that yellow zone, I'm allowed to trade. Like if it opens, here's where it closed, and maybe it opens here, and then it sells off to here, and then maybe does that. And then I notice, hey, that held yesterday's low and the 10-day low, and I've got a 1, 2, 3 entry, and my little R10 or R5 box is there, and I've got 2-to-1 just to yesterday's high. I'm justified in taking that as an intraday trade,
Mhm.
just on the basis of the fact that it was in a compound critical state because of the location and volatility and the framing and the swing trade and all of that. It was in a critical state, and it gave me an intraday setup that was 2-to-1, just trading inside the yellow zone. So if I can get long here, and I make 1R, 2R intraday, and then that thing breaks out of yesterday's high, I'm now justified taking this as a swing entry for a 5DD. Just as a swing trade, even if I didn't trade in this yellow zone, I'm justified in taking this using a full execution risk
Mhm.
to 5 cents below yesterday's low. And if it were to fail, I'd go short because of a collapsing dragon, most likely. And then this trade is good because it's a 1, 2, 3 to the top end there. All right, so maybe some things happen, and maybe I tick one or more of those trades, and I get, wow, I get these two, I
Yeah.
get those 2 days in a row, like you said, right? And I'm happy because I was able to make that entry, and then I made a nice swing trade on those 2 days. Oh, well, maybe I didn't. Maybe I didn't trade those, but now I'm looking at this bar fresh and saying, hey, can I trade that one? And maybe maybe it closed here. It closed here and it opened here, it sold off, went up to here, and then closed there. And now I look at this bar and I say, well, there's my range risk. This is still probably the 10-day high. So I don't even have 1-to-1 here. Because this is not a full, that's not 2 units of risk on this one. So I can't take that as a mechanical entry on the basis of this wide risk, buy it once and then leave it alone all day and play it as a swing trade. I might be able to, like if this was a big enough, if this bar here was a big enough range, hey, what if that thing started to, well, let me draw it as the yellow. What if that thing started to stall? Because there's my yellow zone. What if that thing opened here? And now suddenly there's this big gap down. And what if it holds yesterday's low? And then what if it also reverses intraday? I've still got the same trade here as I did down here because I got my little, hey, support held. I got my little MMRB. I've got a reasonable upside target that has 2-to-1. So I could take that as an intraday trade. But if it breaks through here, I'm not converting that to a swing trade yet because I only have this much extra, gain. So maybe my idea is if it breaks through here, I'm willing to keep trading this thing intraday, but I'm going to exit that whole position before the close, wherever it is. And if this thing breaks out of here and then starts to fail right away, hey, I'm done. I get it. The same thing that made it fail over here is now making it run out of gas over here. So I'll just collect my little 1 day, cash everything, and just see what happens tomorrow. Where do I become interested on this as a swing trade? If the next day it breaks out above the 10-day high, because maybe the 30-day high is up here. Or maybe this is an all-time high. There's no resistance overhead at all. And maybe I'm able to collect some money here on the intraday trade, and I luckily get it to, now I can start thinking about converting this to a swing trade. But in this little region right here, there's just not enough room. There's not enough room inside there to justify a swing trade because of the resistance. When it was over here the last time, it did that. And I can see that. That wouldn't be surprising. It wouldn't be surprising if it just, that's the midpoint of the 10-day, that's the midpoint of the 10-day range. It wouldn't be surprising if this thing rolled over and came back to the 50, came back to the midpoint of this range. That's a reversion to the mean trade. That's the least surprising move of all. So there's no swing trade justified in this space, not until I get a breakout.
Yeah.
But the intraday trade, as long as I can see 2-to-1 inside yesterday's range, I can make that trade. So what I'm doing is I'm looking at the 1-day high and low as key resistance and support, and I'm looking at the 10-day high and low as key resistance and support. And I can trade between the 10s on the swing trade when it gets dramatically oversold. On a 10-day, there's a lot of room for that thing to go to the 10-day high. But if the 1-day range is already well up into here, I could make, but it's still a wide range. I could maybe get a trade inside here, but it's not a swing trade until it breaks out of the 10-day bracket.
Beautiful.
The 30-minute chart is a nice way to see that whole 10-day range, because you can see where all the key turning points are by just looking at the turning points in the Dragon and the RL10. You'll see the boundaries where the buyers took over and where the sellers took over. You'll see those as support and resistance very, very easy on the 30-minute chart. And then when you drill down intraday, and it's interesting, like what I like to do is, hey, if there was a really strong clear channel marked off by that R10 and it sold sharply and then it reversed sharply, I know that's my range inside there. I can trade between those two on 3-minute bars. Once it makes the turn on the 30, I can dial down to a 3-minute and try to fine tune that move with some reason to believe it could get back up to here before it becomes challenging. If this is wide enough, from the peak of the R10 to the belly of the R10, there might be, this is where the Fibonacci guys might say, there's some halfway line. Maybe I can get that, and maybe that's leg 1, and maybe that's leg 2. I don't know. So the 30-minute chart and 10 days is a nice way to look back. And then maybe 1 to 2 days on the 3-minute gives you enough price action for context to see where the turning points are.
Cool. Thank you.
Yeah, so what I would say is typically what you'll see is if that's the average range and your standard deviation or the frog box is like that, and you get 3 frog boxes inside the average range, then that's going to equal a frog quality number of 3.0. What that also means is that if you were to get a range stat move, you get an extra +1 because that's the move from 0 to average +1 is the range stat. So if that thing sold off and then reversed, and you give it a full frog box off the low, you've got 1, 2, 3 frog boxes to the upside if the frog quality number is 3.
Yeah.
So and then we know that if the range stat divided by 10 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. How's that for scale? 3 R10s is usually equal to 1 frog box when you have a frog 3.0. So you can get lots of little start and fail and start and fail and start and fail, and you're just seeing 2 to 1 all the way. Now you have sort of a calibrated lens how big the moves could be before you get surprised. You're not surprised by the size of any moves. Because 85% of the time, it's not going to move a full range stat. But 50% of the time, it'll move an average because of math. That ain't bad. And then if the R10 is too close, just use 2 of them, and now you have an R5. And there's 5 R5s in a range stat. 1, 2, 3, 4, and 5 because of math. So if 2 R10s equals an R5 and 3 R10s equals a frog box, you now have sort of a pretty calibrated way to decide how big your initial risk is for execution. You can properly size that thing. How far does it have to go before you're persuaded that it ain't working? You know?
And then it's okay to use one of those boxes or just the RL10 SSC?
Well, if you have the RL10 comes down and it peaks and you get there's your dragon.
Perfect.
And there is there's your SSC entry, right? Somewhere around there.
Perfect.
This is where that's where your PSAR is going to flip to. Because if this was a harsh winter, that means the PSAR was up here on the other side of the dragon, coming down on these little, like a little garden path. When this move is strong enough so that the R10 crosses this descending line of PSARs, when that happens, when the R10 crosses the PSAR, that's what triggers the PSAR to flip. Why? Because we're using the R10 value to calculate the PSAR. So when the R10 crosses the PSAR, mathematically, it makes it reverse. So that's why the bottom point of the R10 always mathematically must be where the PSAR flips to. And then it'll start moving up. So now you say the technical indicator that tells me that the upward move failed is if price fails through the width of the PSAR flip. So then you can compare, that's the actual technical signal that gets you out. And now you can compare that. How big is this box compared to the R10, the R5, or the frog box? I would just kind of, for position sizing purposes, I would just use the frog box because that's the widest possible stop. You're not going to let it come down here just because you position sized off a frog box, because the price that gets you out is this. That's an actual signal that says the move is over. The space between your actual technical entry and your technical exit, that's the noise box. None of this is a confirmed signal that the trade has failed. The confirmed signal that the trade has failed is when that lower limit was broken, and now that's the signal for a collapsing dragon. So don't worry about trying to maximize your position size. Worry about minimizing the loss on a failed signal. So position size off a frog box. And then this becomes a 0.3 position sizing loss. It's a 1.0 execution risk, but in terms of the actual hit to your capital, it's trivial. And if you're position sizing off a frog box and you're using a 3.0 frog quality number, dude, you got 3 of those to the upside. You don't have to worry about justifying the reward to risk ratio on that. It's certainly there on the intraday trade.
Yeah.
So use this much wider stop to protect your fear mind, your fear instinct, your gut thinking, and then use your rational mind to calculate the precise execution risk and find good non-controversial setups.
That's awesome.
Hey, big gap down, sells off to a fail stat early, stays above yesterday's low, is near the 10-day low, and then gives me a 1, 2, 3 entry. Holy smokes. That's the lowest risk idea you ever saw. Because if this fails, that's the best short entry you ever had. So if you see that with when you feel like taking the 1, 2, 3 entry, because that's the lowest risk idea ever, just already put the short order in at twice the size of your long entry. So that if you get long one here
You're
and
immediately
it fails, it cut one of them, you get short two. One of them covers this, the long, and then you're net short one.
Hmm.
So put in the failure order soon. You know when you could put that one in? If it does a 1-2 in your favor and you're like one bar away from getting this entry long, go and put the short order in right here. In the best of all possible worlds, you never even get the entry and it fails through here and you're already short. That's what you can do while you're waiting for the third bar to close.
Whoa.
Just a thought.
No. Like you say, $1 million idea there.
I mean, 3 minutes is a long time to wait. Good Lord, it takes forever.
Very cool. So thank you for that. And this week I'm gonna concentrate on what you spoke before of Uber. And
Yeah. Now, what you also mentioned in your notes that you were gonna search for compound critical state setups.
yes.
I'm working on a spreadsheet for the 5 sniper patterns. Those make good 1-day compound critical states. So I will make that spreadsheet for you. On the other hand, I would also say that any mechanical swing is good. The auto framer is automatically good because it takes a big sell off from the 10-day high and a range compression doji to give you a favorable 3-to-1 ratio on the auto framer or 2-to-1. That's automatically a good one. Those are automatically good ones.
Awesome.
Just saying.
What you mean on the swing is the different patterns, 5-5-W1 and 5DD and
5-5-1-W, triple screen, channeling, overreaction. Let's see, 5 and washout. Any of those mechanical swings. And then I would also tell you, like I said before, the continuation pattern, which is the biggest percent moves from your herd. Like if you got 10 cows in your herd and one of them was the big move, whichever one ran the hardest today for wins or losses, automatically be ready to trade him tomorrow. Because he's got a wild hair up his ass. He's ready to go.
awesome. Yes.
The sneaky one is the one that has the smallest doji. So let's imagine that you had 10 targets in your herd of usual suspects. And let's say that this one was the one that had the biggest move. It turned out to be he opened and then was a big positive move. And let's say you also had one that was a big negative move. If I was specializing in 10, and the other one's size of their moves were like this, and these were all kind of like average size moves, but this one was exceptionally small, and those two were exceptionally large, and were large directional days. So you're going to get that when you look at the percent move. Like if this was a large range day, but it was a doji, or was there wasn't, it was all tail. I don't know. Maybe that's going to move, but I like to see one that has large directional day with an above average move. This one and those two are going to get my special attention because this one will surprise you on the day that it breaks out. And these things are already in play. They were in play today, especially this one because it closed near the extreme, and this one closed near the extreme. That one's ready to break down tomorrow or ready to rebound. I love that one. That's a poor man's way of finding compound critical setups. 1 day extreme moves that close at an extreme for the day. If you're looking for a 1 day pop right out the gate, how about if today it was a big red candle down, and then tomorrow it was a big gap down, and then gave you an immediate reversal with a 1, 2, 3 entry going the other way? Jesus Christ. How much do I love that? Because the first thing it's got to do is, it's got to close the gap, and then it's got to recover half of yesterday's sell-off. You know what gives you that? The RSI 2. Less than 10. You'll see that on the daily report too. That's a 2-day washout.
That's the regular RSI.
Yep. RSI. But you put a pattern of 2, a look back period. That actually represents 2 harsh selling days. Let's say it was really sideways, choppy shit. And then you had 2 big days of selling, 2 giant red candles. If the next day is a big gap down and then starts reversing, there we go. So you can scan for that with the RSI 2 less than 10. That's on the daily report.
Beautiful.
What you're getting there is the 3rd day volatility. Day 1 volatility that caught them by surprise coming out. This was the 2nd day momentum in the same direction. The gap down was the 3rd day that caught all the slow mice who had orders to sell in the morning at the open. So they gave them that shitty closing, they gave them the shitty selling price at the big gap down, and they're buying inventory on sale. That could be 15%. That sell off from this little sideways quiet. You could get 15% on an individual stock on the 3rd day of sell. By the time you get the 3rd day of selling, that could be huge. So just a technique there. The RSI 2.
Awesome. Thank you. Oh, yeah, that's next week. And
Yeah. Jeffrey, what do you think?
I think this is all great. A lot of ideas, obviously. Can I share my screen, or you want to take notes?
Please do. Please do.
Okay. This week, worked through some NinjaTrader back testing and data issues, got them figured out. Added the trade reentry and continuation patterns to the PRX strategy 1 in NinjaTrader.
Yep.
So that was good. Coded the basic strategy in Quant Connect. Still has a lot of particulars I need to put in, but we got the basic working, and having a little bit of issues matching up the trades to
Yep.
The base system. But anyway, and my idea on this is I'm going to do a go, no go once I get to paper trade multiple symbols in Quant Connect to make sure that what I think is going to be the advantages of that platform are really there. And then I also hired my son as an intern on a trial basis. He's going to do 150 hours as an intern, and then I'll pay him for the next 150, and we'll put that in IRA. So,
What's his level of experience?
he is in college right now doing computer programming, and is taking some Python classes, which I have not.
Yeah.
So I'm going to kind of use it as a.
If you're interested, what I could recommend, if you're looking to get him some width,
Yes, sir.
is I think the book club sessions,
Okay. Yeah.
the once a week where I'm summarizing 10% of the book once a week for 10 weeks.
Okay.
Well, we just finished the 6th session. If you send me his email, I think he should listen to those 6 hours so far.
Yes,
Like
sir.
if I was going to hire him and give him 150 hours of training as an intern, the first 10 that I would give him,
Sure.
the first 10 that I would give him is those 10 lectures because they are dynamite. They are really, really the book is geared to people that have never experienced our trading techniques. And I made no assumptions that they had any prior experience. So it's really geared towards that sort of entry level. Don't make any assumptions, just building block, but it's sort of rapid fire with good visuals and good references and coded to the pages in the book where the ideas are discussed in writing. And it comes with really good one-page summary of notes for each of those nightly discussions in the form of the Cornell note sheet. And you would find those to be very helpful in your discussions with him about our basic ideas.
Great idea. I love that. So
Just send me his email. We'll get him hooked up.
I will definitely do that. Awesome. This week I'm going to start paper trading the PRX System 1 and Ninja Trader. GBTC is my first symbol. I'm looking at 30 minutes. 15 is okay. 5 looks spectacular, but literally 2 slippage points, on the entry and exit is knocking the profit down by 2/3. So obviously it's too thin down there.
Yeah.
So I'm probably going to do the 30. I'm going to look a little bit more at the
Yeah.
5-15, but I doubt it. I am planning on, there's some Quant Connect programmers out there I've run across on Upwork. I've used them to hire other programmers for my day job before. So
Yeah.
a couple of them are real reasonable. So I'm going to get them just to go ahead and give me a skeleton framework of the strategy, just to probably save me 2 weeks of coding to do that. I'm going to finish the first draft of the trading plan. I've started on that per your recommendation 3 weeks ago. And I also saw the trading system plan you had up at the very beginning, the
Yep.
meta trading system. So I don't know if you were going to talk about that or not, but that's looks great. Also,
Did you get a screenshot of that?
Yes, sir, I did. So
Okay, because I
I'll
could
kinda-
put that up.
no, I'll take that as a template. So that's exactly kind of what I was hoping for.
Yeah, I mean, what we did that for Van back in the days, probably 25 years ago when we were first. He was it ended up becoming his blueprint for trading success business plan.
Gotcha.
It became much more elaborate, but
Right.
that was sort of the outline of the sections, and then he and RJ turned that into a very detailed trading plan. But it was basically off that principle that you have a trading strategy which has all of those parts, filters, setups, entries, exits, position sizing, all that jazz. And then that was a rule set for one trading system. And then you had multiple of those. Yeah. And then all of your trading systems simply become part of your overall trading strategy, which is like your golfing strategy. How am I going to use those clubs in my bag to get around the course? And then all of the other parts of that meta trading system is what are all the things that I got to do as a business in order to support my golfing habit? And
Right.
and that becomes the meta
Sure.
system.
So I'll be working on the trading system over here on the right, and then I'm going to move over to the meta after that. So I think that's great and timely.
Yeah.
Thank you.
Sounds good.
And so I think that was about it under what I was going to do.
Yeah, I'm going to introduce Everett to my son, Stephen. He's been working with Python for programming for doing the finding setups in the different sniper patterns. So I've got him working that with I think he's using Yahoo Finance or maybe IQ Feed. But so he's got some skills with Python as for programming for trading and finance as well. They might they might end up talking to each other.
That'd be great. Yeah.
So that's what I'll send Everett the invite to the book club workshop, and he can download the videos, because we've been recording the sessions, and download the note sheets. And you just,
Yeah,
in fact, you tell them to do it, and then you can, that's just
I'll-
check on learning to make
I'll
sure
make
they
it, I'll
actually
make
did
it like, I love what you said. I'll make it part of the initial hours. So there
Yeah.
you go.
That's right.
It'll be
Find
homework.
this site, sign it, accept the invitation, find the downloads,
You bet.
show me the PDFs, and then have him ask questions. What is it about this that you don't understand?
Yeah, great. That'll be a good
And
test.
then we'll follow up with that.
Sure. Okay. Yeah, great. Coach's eye, the only thing I had really this week was do better with time blocking. I'm manic, it's a lot of trading and then a lot of day job and then a lot of trading. So
Yeah.
I need to just get a little
Sure.
bit more steady there. And then just for accountability, my plan is to have interviewed and maybe hired one of the Quant Connect programmers. I'm expecting 1 to 2 week turnaround on the complete thing.
Yeah.
And then I'll send you the first draft of the trading plan for the PRX system.
Okay. Hey, what's the going rate? Is that an hourly rate at the
Yeah, again, there's not a lot of the Quant Connect guys, but there was about 4 of them that mentioned Quant Connect.
Yeah.
Overseas guys were around 20 to, I think one guy's between 20 and $40. US guy, Israeli guy, I think was 40, and he looked
Yeah.
like pretty good. And then
Okay.
you can pick up some US or Canadian guys, but they're over $100 an hour. One was at 200 an hour. So
Yeah.
So obviously I'm going to look at offshoring it.
Code is code?
And at the end of the day, it is. And most of the guys I've worked with in Bangladesh and India are they'll meet you halfway. And so
Yeah, they're good and hungry. I like that.
and you
That's
meet them in
smart.
the morning or
Yep.
in the evening when
Yep.
it's early or late, but they'll do that. So anyway, so
Sounds
that's what I'm finding. So that's
Okay.
all I have. So
All right, fellas. Good work. Keep up the fire. A lot of good detailed stuff here. I would also tell you that the foundation's Q&A from yesterday, I went deeply into the BMR, blended monthly rebalancing, and the ETF2, and how to read that part of the weekend report. And in terms of market classification and finding swing candidates, I thought it was really, really well done. So I'm going to get that. I'm still processing the damn video. I had to reprocess it, and it looks like it just finished. So that's one that I would strongly encourage you to listen to. I'm going to put it in the small group as well as in foundations, but that's one that I would really pay attention to, because there's some very efficient ways of finding easy targets, how to scan 500 symbols and find a couple easy targets on those longer term and core positions. I think I did a good job explaining that. And sometimes in the rush to get into the tactical things, it would sometimes miss some of the easier long-term rules of thumb. So I would make a note to listen to that one. I just got to check the video, make sure that it actually processed, but it should be okay. All right. Well, that's everything I got here, fellas. We'll be ready to get after them tomorrow. Keep up the fire. You guys are doing great.
Well, thanks, Ken.
thank you.
Sure.
Yep. Ciao for now.
See you.
Good night. Thank you.